Okay. Guy, welcome very much to Scaling Europe. We are thrilled to have you.
Hi, Seb. It's great to meet. Thanks for having me.
My pleasure. Why don't you just kick us off by giving a quick intro into who you are and what you do?
Yeah, absolutely. So I'm one of the six partners at a venture capital fund called DN Capital. We're a Series A focused fund with about $1 billion of assets under management, and we invest predominantly in Europe and the US.
Amazing. How did you get into venture capital?
So I was lucky enough to have some friends who were working in VC before I took the move over, and was lucky enough to have opportunity to speak with them about their career. And so they persuaded me. They were working in various funds, Eight Roads, Highland, and they blazed the trail for me.
Yeah, amazing. And DN Capital, yeah, very big across the continent, great investors, an amazing portfolio. Can you talk a bit about, you mentioned Series A, but is it specific sectors, specific industries? What kind of things does the team focus on?
Yeah, absolutely. So we think of ourselves as an early stage fund. So that means seed and Series A focus. We do tickets of $2 to $10 million roughly. And in terms of sectors, we really divide the world into two areas. We have an enterprise software and AI team where we've done deals like Encode, Cognigy, and Endeca. And then we have a consumer internet focused team where we've invested in companies like AutoOne, Remitly, and Shazam.
And what's your primary focus?
So I'm much more on that first team, enterprise AI and software. I specifically focus more recently in companies that are selling software into financial services and selling AI and automation tools into financial services.
Interesting. So I guess that's quite a niche. Like, why are you focusing there at the moment?
Well, one of the things that we've realized is that the most exciting place to deploy artificial intelligence and a lot of the latest generation of technologies is in complex industries, solving difficult problems. And financial services is one of the biggest places where you can do that. There's regulation, there's data security concerns, there's big legacy tech stacks, and those are the kind of problems that we think are the most exciting to solve from the perspective of creating moat and differentiation long term.
Got it. And I think an example would be Fimple. Is that right? Because that's almost like cloud banking software. Is that, have I understood that correctly? So is that an example of that, the type of company that you're looking for?
Absolutely right. So I did 3 deals last year. One was Fimple, which is a modular, composable core banking system focusing actually on the Middle East, North Africa, and Turkey. Another was a company called Unique, which is an agentic AI platform for the financial services industry, working with some of Europe's biggest banks, and they're really helping those banks to deploy AI in a compliant, safe, and productive and efficient way.
Amazing. And what was it that kind of excited you about some of those companies?
Well, as I said, we're early stage, so the most exciting thing is almost always the team that you work with. So both of those companies were founded by people who you would call, I guess, kind of industry veterans or repeat founders, people who really knew what they were doing, who understood the complexity of enterprise software. And I think that's something we spend a lot of time trying to work out when we meet founders for the first time. How familiar are they with the kind of problems they're going to encounter when they go into large enterprises to deploy their softwares? Then the other is just the size of those opportunities. One thing that we see in financial services is very large companies with big brands and big balance sheets, a big willingness to invest, but not necessarily the strongest internal capabilities to build their own tools.
Got it. Okay, so you see there's a real opportunity there for technical teams who are using that kind of like new and advanced tooling to help some of those legacy players. I wanted to talk quickly about Cognigy, right? Cognigy.
Cognigy is...
Cognigy. Is that it? Cognigy.
Yeah, Cognigy.
It was in the news like a month or two ago. DN Capital was all over it about the acquisition. You were on the board for a number of years. I think you led the investment. Was it a number of years?
That's right. We led the Series A round in 2019.
Are you able to take us on a bit of that journey? You know, why DN Capital initially invested, what it's been like the last 5 or 6 years, and now what it's like to have that amazing exit?
Yeah, absolutely. I think first of all, big hat tip to the team who did really all of the hard work and incredible job on it. When we first invested in the company, the space was very noisy. It was very easy to dismiss the space as just another chatbot company. And so one of the things that we spent a lot of time doing was meeting all of the different players in Europe and some of the players in the US, and really trying to understand what we thought was the winning product vision for the space. Because at the time, a lot of these companies were of similar sizes, similar revenues. They all had a few flagship logos. They were all doing what you might call essentially the same thing. But what we saw in Cognigy was a company with a very holistic product vision that always built with the idea of how do you build enterprise flexibility into the product. So they were always very focused on that enterprise challenge. So we led the Series A in 2019. At that time, there were a bunch of different companies globally that were trying to solve this space, and that narrowed down very quickly over the next 3 to 4 years to 3 or 4 global leaders, of which Cognigy was one. And I think the reason that Cognigy were able to get there was a real focus on product and making their customers happy, and not getting too caught up in the VC hype and trying to make investors happy all the time.
Yeah, amazing. And it's a remarkable story. I remember when I spoke about it on LinkedIn, and there was some pushback from people who were saying that although it's an amazing outcome, an amazing result, it was ultimately sold to a US company. And we're seeing a lot of this, like a lot of the US bigger tech giants snapping up both the European talent and European tech companies. What's your take on it? I mean, what's your take on the US companies coming in and buying out European companies?
I think, first of all, we have to take the win. The first thing is, look, this shows that we're able to build globally leading technology companies. And if you look at any technology analyst report on the space, Cognigy were listed number 1 or number 2, whether that's Gartner, Forrester, IDC, Opus. Cognigy had built the best platform in this space. So let's look at the positive side first, that we have the talent and we have the ambition and the funding ecosystem able to get us to that point. But I think we have to take the criticism as Europe. We have to take that criticism seriously, which is we can't rest on our laurels with a $1 billion exit in AI. I mean, in the long term, that's going to be it's going to be eclipsed, hopefully, by a lot of other larger businesses. And I think we do need to think carefully about how do we make it exciting for founders to keep building in Europe? And what does that mean in terms of, and it's really at that growth stage that I'm talking. Once businesses have scaled, I think our early stage ecosystem is very healthy. But what do we need to do in terms of public market reform to make it exciting for companies to stay in Europe and list in Europe? What do we need to do in terms of talent density that allows you to scale a business from 200 FTEs to 2,000 FTEs, or which is the kind of level you need to be when you're looking to emulate businesses like Salesforce or OpenAI or take your pick of global software leaders.
Yeah, and do you looking at recent news, recent rumors, like someone like Mistral AI rumored to be potentially being acquired by Apple, do you see that as a problem in terms of Europe owning some part of its own tech stack? Or again, do you think that could be an amazing result for a lot of early investors, provide a lot of capital and a lot of liquidity, which could then help further the ecosystem?
I think at the first stage, we need to consider what makes sense for these businesses and to keep the innovation that these companies are doing going. And in the case of Cognigy and NICE, in the case of potentially Mistral and Apple, you're talking about strategic link-ups that make a lot of sense for the companies involved. And that strategic business logic has to take precedence, I think, over whatever long-term European flag waving we want to be doing. Venture is a long-term industry. We can't be looking to the current generation of entrepreneurs to solve this problem in a heartbeat. We need to be thinking more systemically about, in 5 years' time, when you have the next Cognigy or the next Mistral, what are the set of environmental factors we need for those companies to have to persuade them to keep going and build the $10 billion, the $100 billion business that we know we can build in Europe with the talent we have, but we don't currently have the incentive structure that encourages people to keep going and do that.
Yeah, okay. So you think it's about fixing the capital markets, fixing that late stage growth capital to equip founders, European companies with the tools to carry on building.
I would focus on two things: the IPO market,
Yeah.
because if you look at the US and the big companies in the US, they go public, and they know that the public markets there are going to reward innovation and growth, and they have the investors and the liquidity in those markets to do that. I don't think we've convinced entrepreneurs that that is the case in Europe, and we need to do a better job of that. And the other thing is talent. We have the talent to start businesses, but do we have the depth of talent to keep building and compounding those companies to become $100 billion type companies? I'm not sure we necessarily do.
That's not an opinion I've heard on this show. So you think that perhaps there's like a gap of talent specifically around helping companies maybe go from Series B, Series C to that IPO stage?
For me, it's less the type of talent, it's more the talent density. So if you look at Silicon Valley or maybe New York, you have incredible talent density in those markets to build very, very large companies. In Europe, we are more fragmented in terms of where our talent sits. So many of the companies that we found in Europe, they get to a certain scale and then they think, okay, we need to open a separate European hub somewhere, or maybe we need to open a US hub in order to keep attracting and the kind of talent we need to keep the business going. We haven't built that kind of depth that you see in Silicon Valley that would enable you to hire enough people to scale the kind of business that we're talking about in Europe. And then I think the other thing is just look at the top technical universities in Europe versus the US. The universities in the US have more funding. There are more of them. At least until recently, they were very good at attracting international talent to those universities. And we have an opportunity now as Europe, I think, to really become a beacon and elevate some of those technical universities that we have in Europe, whether that's TUM, ETH, Oxford, Cambridge, Imperial, and bring the best talent from around the world and get them to set up and join great companies in Europe.
And do you think European governments and European universities should be doing more to take advantage of the opportunity that the US is potentially giving us by not being so attractive to international students at the moment?
Yeah, I mean, I don't think we should see it as necessarily a competition with the US. I think we should be doing it regardless, right? We want to make Europe as attractive a place for the best talent in the world to come, study, and create businesses. Yes, I think right now we have an opportunity to put Europe up as a credible alternative, but it actually takes a lot of work, I think, before the best students in India or Hong Kong are going to look at Europe and put it side by side with MIT and Stanford and say, okay, that's the place I'm going to go and study and build my business.
Got it. I want to talk about your career, your kind of getting into venture. We just had Will on. Will was an Exit founder who then turned VC. We've spoken to Peter Specht a few weeks ago, who joined Creandum, very junior, rose all the way through the ranks to partner. You've done something very, very similar at DN Capital, kind of joining as a junior mid-level VC and being promoted pretty quickly by VC standards to partner level. I'd love to know, how have you managed to do that? And have you got any advice to other people who are maybe associate principal level? What does it take to really get to that partner level?
I think the first thing I would say is forget speed. Don't try and be quick. Never try and do anything quickly in venture. It's a long game, and shortcuts tend to come back to bite you. And whenever I've taken them, they definitely came back to bite. So, and I think if you try and do things too quickly, you'll chase hype and you'll chase momentum, and that's rarely the best route to building a good portfolio in venture. I would say two things. Really try to compound good decisions. I think building a good career in venture is really about just compounding good decisions over and over again, whether that's the people you meet, the companies you invest in, your approach and investment framework. Try to build those things out. I would say the other thing is really try to become a domain expert in one area. Become the person that founders and other investors want to speak to on a particular subject and who respect your knowledge and perspective in that space.
Got it. Okay, so try and carve out your niche, become an expert, and then I guess deal flow will come more naturally to your doorstep. You'll become a trusted voice in that area.
Yeah, exactly right. Like if you're joining a venture fund now as an associate, let's say, there are so many new areas of technology that frankly the partners will not have had the chance to fully research and get up to speed on themselves because they're sitting on 10 boards and they've got legacy portfolio to manage and think about. you as a new associate have a real opportunity to find new areas of innovation and say, I'm going to make this my own. If you do that within a firm, it gives you a great opportunity to really stand out.
No, that's a great point. You mentioned there the kind of sitting on boards and that taking, I guess, like a decent chunk of like a VC partner's time. I want to get into, you've got experience sitting on a number of boards currently. What is the role of a VC who sits on the board of a startup?
First job, if companies are going well, is to make sure you get out of the way. Fundamentally, you're there to help this company build. I would say, I would like to think where we've been most helpful to our companies is more in the strategic advice domain. That's what milestones you need to hit when to fundraise. You're in a sticky situation, and if you're in a sticky situation as a founder, our objective is to be the investor that you want to call at that time and talk through those problems. I think every VC fund will talk about introductions and hiring and can you help with internationalization, and I think if you're sitting on a board, you're definitely doing all of that. But I think founders appreciate the investors who get their businesses and who really spend the time to understand them and are able to help them think through strategic problems, whether those are commercial or whether those are funding related.
And do you think there's a limit to how many boards a VC partner can sit on to kind of make sure they have that depth on each company that they serve?
Yes, and I think it's going to vary from one individual to another. So I don't think there's one number for the whole industry. Depends how many new deals you're trying to do at the same time. Depends, how much, bandwidth you have as an individual to be able to do those things. We all have different kind of constraints, I guess. But I think it's hard if you're seeing a VC come to you as a founder and say, I already sit on 20 boards, but I'm going to make you my one special snowflake. You should question that.
Yeah, that makes sense. I want to talk also, you've been in VC for a number of years now, and VC, as you mentioned, is a long-term game. But I think you joined DN maybe 2018, 2019, was it?
No, I joined earlier. I was in 2015. I joined.
Oh, 2015.
Yeah.
Okay, so yeah, like you spent a decade in venture now. How has the market changed? You've obviously been through, I guess, the hype bubble of 2021. We're sort of, people are saying we're now in another hype bubble with AI. What have you seen change, and kind of where do you think venture is at the moment?
Yeah, it's a great question. We're definitely seeing a bifurcation in the market where you're seeing a few very, very hyped companies or very fast-growing companies getting a lot of excitement, and I think there is then a cohort of other good businesses that are maybe getting a little bit less attention as a consequence of the hype around some of the fastest growing businesses, which I think is an internalization of the power law dynamics that people have really realized play out in venture. Which I think could well be justified at a certain point, but I'm not sure that it's going to yield the best returns environment if everyone is chasing, a few businesses and not spreading their nets wider to look at the great areas of innovation that are happening elsewhere. And that's both a geographical comment and a sector comment. So one of the things that we're doing at DN is really trying to focus on where do we see the most complex problems to solve, which may not be the ones that you're able to solve most quickly and show the most stellar 10x year-on-year type growth, but is innovation that you can compound year after year and will lead to much more sustainable and exciting long-term businesses with more moat. So I think that's one of the trends. Are you going after top-line metrics, or are you building to solve very complex long-term problems? I think there's a really exciting resurgence in deep tech, which I think is deep tech and defense tech, which were terms that weren't really bandied around at all when I joined the industry. There was a lot more of a focus on kind of consumer internet investments at that time, and I think consumer internet has got a bit quieter. But I think it's also a space that we think is exciting and interesting to keep looking at.
So it sounds like you're not changing the way that you're necessarily assessing companies too much. You're still looking for I guess, like amazing founders who are building products that can solve real problems. I've spoken to other investors who now say that they are looking for higher revenue growth and looking for leaner teams in the age of AI. Are you doing the same to an extent, or are you less focused on the revenue growth, less focused on team size? Those things are kind of stayed constant. You're more focused on, are they solving a real problem for a big market?
The main thing that we always focus on is how real is this problem? How effectively does this company solve it? And do we believe this is the team that can continue to grow and develop and is demonstrating real vision in the space to go and solve something long term? In terms of the revenue, benchmarks are shifting. The growth of new AI companies are shifting benchmarks, but I'm not sure we've yet agreed on the consensus for what the benchmark should be. Because if I'm growing ARR 10 times year on year, but that ARR is retaining at 20% in month 6 and it's at 0% gross margin, I shouldn't be considering that on the same basis as I used to consider ARR that was retaining at 95% annually and at 85% gross margin. So benchmarks are shifting. We're expecting faster growth, but some of that growth is lower quality revenue. So everyone is in the process of resetting their benchmarks for different industries depending on what products you're building.
We see a lot of stuff about top line growth, ARR, revenue. Something I'm going to be getting into with Saul Klein later on, because we've just seen the release of this big report about European thoroughbreds. One of the questions that I was going to put to him, and I'm actually curious to hear your take on this, is ARR still a useful metric for companies to talk about when, to your point, we're not sure if it's annual and we're not sure if it's recurring?
I think the term ARR has become diluted to the point where it's not that useful to talk about, or it's often used to dress up revenues as something, or make people perceive those revenues as something that they're not. So maybe we need some different lexicology for the AI age to talk about revenues. I think if there's one thing the VC industry is good at, is nomenclature. So I'm sure someone's going to come up with it at some point. There'll be some new jargon.
And what about gross margin? You touched on that. We're seeing a lot of AI companies, hit revenue milestones very, very quickly, but no one's really talking about margin. Are you seeing that with companies, with AI-specific companies, that they generally do have much lower margins because of the cost of running the models?
It really varies. Cognigy, for example, which was an AI business using, calling the main models, its cost for the models was minuscule, and its margins on product were 85% plus. But then you're seeing a lot of the new vibe coding businesses, they're using the models in a much heavier way, and you're seeing margins that are maybe negative or maybe around break even or whatever they are, and so that paints a very different picture. I think there's an interesting bet that you're taking here, which is, can I grow fast enough, build enough user adoption, build enough brand recognition to attract enough capital to build great product that in the long term will yield higher margins? And will the open source community of models allow me to reduce my cost of goods served? I think it's a really reasonable venture bet to take, but it is ultimately a bet. And long term, I think you always have to be aware that selling something for below cost is always easy to get fast growth when you're doing that. But that being said, I think the approach that some of the new AI businesses are taking may well pay out in the long run, but it won't pay out for all of them.
What's your take, I guess? Do you think that that's a good, not just like a bet worth backing, but do you think that's going to come to fruition? Do you think that the model costs are going to drop dramatically enough to kind of no longer need the venture subsidies to keep these businesses going?
I think it's a reasonable bet to take. If you look at what's going on in the open source community, if you look at what the amount of funding and innovation going into models in different parts of the world, do I think there's a reasonable chance that you'll be able to get models of sufficient quality to have on an open source basis and that are a lot more cost effective? I think it's a reasonable venture bet. I would say we at DN Capital are much more interested in taking a different kind of bet, which is applying AI to vertical industry problems and saying, how do we build solutions to solve the problems that this industry is facing, and building moat in that direction.
Yeah, amazing. God, and one last question before I let you go. I'm conscious we're over time. DN Capital Is it exclusively Series A? Is that right?
We do seed investments as well. So we
Got it.
will, especially where we see exceptional product and market and founder fit. So where we have a founder that fits a market very, very well.
Interesting. And what do you think the state of kind of that stage of investing is at the moment? Are you seeing a big change in Series A seed investing? You know, valuations higher, people willing to write bigger checks? Is it getting more competitive? What's your take on that?
There's definitely a phenomenon of businesses jumping what would have been called the traditional Series A. So the companies that, whatever, angel strap, seed strap, and then managed to surpass what you would have called traditional Series A milestones before, and then raise a much, much larger, what we would have called a kind of B round. So the Series A is being a bit squeezed from top and from bottom. I think people are now going to have to get used to doing Series A's much more on the basis of product quality, founder quality, and early signs of market traction rather than particular revenue metrics. I think the days of going, oh, well, you have to have hit 2 million ARR or I won't look at you for a Series A. I think those days are gone. You need to go earlier with your thinking.
And does that change your ability to get access to certain deals, or does DN Capital have a bit of flexibility about check size, whether you lead, whether you support?
So I think access is something that you win by knowing the space and convincing founders that you're the right investor and partner for them. And then you need a little bit of flexibility in your fund structure to go smaller or larger in terms of ticket size. So I think everyone will be aware of the need to be dynamic at the moment to fit their investment strategy to what the market needs.
Got it. No, that's really interesting. Well, look, thank you so much for coming on. I've loved chatting. But look, let's stay in touch. And you know, if you've got portfolio news or you want to come on at any time, just let me know.
Yeah, likewise, Seb. It's been a real pleasure. Thanks for inviting me.
Thanks. I'll speak soon. Bye-bye.
Speak soon.